Stop looking at the silver price on your phone. Right now, December 31st, 2025, just hours before midnight, there are two prices for silver operating on this planet. In New York, COMEX futures are trading at $74.59 per ounce. That's the number you see on Bloomberg. That's the number on TradingView. That's the official global benchmark. But 5,000 miles to the east in Shenzhen, China, where factories actually need silver to keep production lines running, industrial buyers are paying $100 per ounce for immediate physical delivery. Not 74. 100. That's a $25 gap. In the world of commodity markets, we don't call that a spread. We call that a broken market. And here's what nobody's telling you. That $25 gap isn't just a pricing anomaly. It's a vacuum. It's pulling physical silver out of Western vaults and shipping it east bar by bar, day by day, in a one-way flow that's draining the system. The question isn't whether this gap closes. The question is, does COMEX run out of silver before it can close? Let me show you what I'm looking at. On my left screen, COMEX Silver Futures, December 31st, 2025. Live data from the CME Group website. Spot price, $74.59. This is the paper market futures contracts traded in New York. Traders buying and selling contracts, promises to deliver silver in the future. This price assumes silver is abundant, that delivery is always available, that the system works. On my right, reports from the Shanghai Gold Exchange showing official spot around $78, and dealer communications from China indicating premiums in Shenzhen, where solar manufacturers and EV makers are scrambling for physical metal, hitting the $95 to $100 range for immediate industrial delivery. I need to be clear about sourcing. The COMEX price is confirmed. You can verify it yourself right now. The China $100 figure comes from multiple industry reports over the past 2 weeks. I haven't personally called a Shenzhen dealer to confirm that exact number, so I'm labeling this as likely based on multiple reports. Needs direct verification. But even if the real number is 95 or 90, we're still looking at a $20 plus gap. Unprecedented. In normal market conditions, the spread between New York and Shanghai never exceeds $1 to $2. A $5 spread is unusual. A $10 spread would be a red flag. $25 is a 5-alarm fire. Here are the numbers we can confirm. COMEX spot silver, $74.59. Shanghai Gold Exchange official, around 78. Dealer premium reports from China, 95 to 100 range. Gap, $20 to $25 depending on exact quote. Historical COMEX Shanghai spread from 2015 through 2024, 50 cents to $2 in stable conditions. We have never seen a gap this wide in the 50-year history of COMEX silver trading. So why does this gap exist? Why hasn't arbitrage closed it? Here's the mechanism. Arbitrage, that's finance speak for buy low in one place, sell high in another, pocket the difference. It's supposed to keep prices aligned globally. But when the gap is this big, it tells you something's broken. If you're a bullion dealer, you can buy silver in New York at 74, pay shipping and insurance to China, about 50 cents per ounce, and sell in Shenzhen at 100. Profit, $25.50 per ounce. On a standard 10,000-ounce shipment, that's $255,000 profit in 1 week. Return on capital, 34% in 7 days. Risk, near zero. In finance, we call this an infinite money glitch. It's arbitrage so profitable that every rational actor does it. So what's happening right now? Every available bar in London, Zurich, and New York that can be legally exported is being allocated for shipment to China. Vaults are being swept. There's a giant sucking sound coming from the east. As this metal leaves the west, local supply in New York drops. When supply drops toward zero, the price must rise. It has to rise until it becomes too expensive to ship to China, until the gap closes. But the paper market in New York is still pricing silver as if it's abundant. COMEX is a futures market. Traders buy and sell contracts, not physical bars. Most contracts get rolled forward or cash settled. The system assumes there's always metal available if someone wants delivery. But the metal is fleeing. It's going to China. And in January 2026, 31 hours from now, COMEX faces its monthly delivery cycle, when traders can demand physical silver, not just paper contracts. If there's not enough silver in the vaults to deliver, the system has a choice. Pay cash instead, or admit they can't fulfill. Either way, the paper price loses credibility. Who's paying $100 in China? Solar manufacturers control over 80% of global solar panel production. Silver paste is critical for photovoltaic cells. There's no substitute in current technology. If a gigafactory runs out of silver, it shuts down, costing millions per day. So if silver jumps to 100, they pay it. Silver cost per panel is maybe $20 to $30. The panel sells for $200 to $400. Shutdown cost: $1 to $5 million daily. The decision is simple. Electric vehicle manufacturers use 50% more silver than combustion vehicles. Silver contacts in battery systems, motor controls. China is the world's largest EV market. Production targets are government-mandated, not price-sensitive. And Chinese retail buyers, seeing property markets down 20 to 30%, stock markets volatile, capital controls tight, are rushing into gold and silver to preserve wealth. This is panic buying. They're not speculating, they're surviving. This is inelastic demand. Industrial buyers don't care if silver is 74 or 100. The cost of silver is tiny compared to the cost of shutting down a factory or missing production quotas. Here's the insight most people are missing. This isn't a story about silver going up. This is a story about two markets decoupling, one based on paper contracts, one based on physical scarcity. For 50 years, COMEX in New York set the global price. If silver dropped in New York, it dropped everywhere. That relationship is dead. China is now the price setter. New York is the price taker. Why? Because the consumer always sets the final price. If Samsung and BYD and Chinese solar manufacturers are willing to pay $100, then silver is worth $100. It doesn't matter what a futures trader in New York says on a screen. The real price is the price at which a transaction occurs. And transactions are occurring at triple digits. This is a pricing authority shift from west to east. Most traders haven't realized it yet. And why does this matter to you, even if you don't trade silver? Because for 50 years, commodity markets have operated on a single principle. New York sets the price, the world follows. If that breaks for silver, the question becomes, can it break for copper? For gold? For oil? This isn't just about one metal. It's about whether the entire global commodity pricing system, built on paper contracts and assumed deliverability, still works when physical supply runs tight. That's the systemic risk here. And it all comes down to a simple question. Can COMEX still deliver the metal? Now, you might be thinking, okay, there's a gap. But vaults have inventory. COMEX has been around for 50 years. They can just deliver the silver and close the gap, right? That's what I thought too. And then I looked at the inventory numbers over the past 5 years. And the numbers tell a very different story than what you see on the price screen. Let me show you what's been happening to those vaults. Here's the number that should terrify every COMEX trader. 82 million ounces. That's how much registered silver available for immediate delivery, was sitting in COMEX-approved vaults as of the last confirmed data from 2023. In 2020, that number was 346 million ounces. That's a 70% decline in 3 years. That $25 gap we just talked about, that gap isn't causing the drain. The gap is revealing the drain. The vaults have been emptying for 5 years. Quietly, steadily, relentlessly. The $25 gap is just the market screaming, we're running out. I'm going to walk you through 5 data points. Each one alone would be concerning. Together, they paint a picture of a supply chain being drained faster than it can refill. First, vault depletion. COMEX registered inventory in 2020 was 346 million ounces. By 2023, it dropped to 82 million. I need to flag something. That 82 million figure is from 2023. I haven't pulled the December 2025 update yet. CME publishes vault data, and I'll check it as we head into January. But even if it's ticked back to 90 or 95 million, we're still talking about a massive structural drawdown. London vaults? Industry reports describe them as running on fumes. These are anecdotal, not official LBMA disclosures. Shanghai, official reports show inventory at lowest levels in 10 years. This isn't New York having a bad quarter while London picks up slack. This is global inventory depletion. Second, structural deficit. Why are vaults draining? Because the market has been in deficit for 5 consecutive years. Total demand in 2025, 1.24 billion ounces. Industrial use 900 million, mostly solar panels. Investment demand 200 million. Jewelry 140 million. Total supply 1.01 billion ounces. Mine production 835 million. Recycling 175 million. Annual deficit 230 million ounces. That's the entire annual mine production of Mexico, the world's largest producer, short every single year. 5-year cumulative deficit, 800 million ounces drawn from above-ground stocks. Where did that come from? Vaults, ETF liquidations, government stockpiles, every available source. And now those sources are running dry. Third, inelastic demand. Solar panels consumed 200 million ounces in 2025. By 2030, projections hit 300 million if IEA solar capacity targets are met. Silver paste is used in photovoltaic cells. There's no substitute. New solar tech uses 50% more silver per panel than older designs. As solar scales up, silver demand goes up regardless of price. Electric vehicles use 50% more silver than combustion vehicles. China is the largest EV market. Production targets are government mandated. If silver doubles from $30 to $60, the silver cost per EV goes from $50 to $200. On a $40,000 vehicle, that's 0.5%. Manufacturers pay it. Safe haven demand in China? Property market down 20 to 30%. Stock market down 15% year to date. Capital controls make it difficult to move money offshore. Result: flight to gold and silver. When people are fleeing asset collapse, they don't stop buying because price goes up. They buy more. This isn't speculative buying. This is panic preservation. Fourth, inelastic supply. Only 20 to 25% of global silver comes from primary silver mines. 75 to 80% comes as a byproduct of copper, zinc, lead, and gold mining. When you mine copper, you get silver as a bonus. But you're mining for the copper. Higher silver prices don't automatically increase silver supply, unless copper and zinc prices justify opening more base metal mines. Right now, they don't. New mines take 5 to 10 years from discovery to production. Capital required: $500 million to $2 billion for a large mine. Looking at the project pipeline, there are no major new silver mines coming online in the next 24 months that would materially shift supply. Mine production has been flat at 810 to 840 million ounces annually for 5 years. Fifth, China export controls. Tomorrow, January 1st, 2026, in less than 24 hours, China implements export controls on silver. This is official Ministry of Commerce policy announced December 9th. Any company wanting to export silver from China must obtain a license. Requirements: minimum production capacity 80 tons per year, credit line around $30 million. This shuts out small and medium exporters. Previously, arbitrage could flow both ways. If China had excess, it could export to the West. Now it's a one-way valve. Silver can flow into China via imports, no restrictions. Silver cannot easily flow out. China is locking in domestic supply for solar and EV industries. When the announcement dropped December 9th, silver spiked 8% in 48 hours. Here's how these 5 pillars interact. Structural deficit means the market is short 230 million ounces annually. That draws from inventory. Vault depletion creates tightness. Tightness creates the China premium. The premium creates arbitrage. Arbitrage accelerates the drain west to east. China export controls mean the drain can't reverse. Supply can't catch up because mining is byproduct economics. Demand won't drop because solar, EV, and safe haven buying are inelastic. A one-way drain with no relief valve. This isn't a temporary squeeze. This is a structural imbalance that can only resolve through price adjustment or system break. There's no third option. The silver market isn't tight because of speculation. It's tight because the supply chain is being drained faster than it can refill, and the mechanisms that would normally rebalance it are broken. Vaults down 70%. 5 years of deficit, 800 million ounces drawn. Demand that won't drop. Supply that can't rise. And now China blocks the exit. This isn't a rally. This is a system running out of slack. And when a system runs out of slack, it becomes brittle. One shock, one unexpected surge in demand, one delivery failure, one bank that can't cover, and it snaps. And that shock? It's coming in 31 hours. January 2026 is a delivery month at COMEX. That's when traders who hold futures can say, I'm standing for delivery. I want the metal. With a $25 arbitrage opportunity, every rational trader should demand delivery. The question is, does COMEX have 82 million ounces left? Or has it kept draining? That's the delivery test. And that's what we need to talk about next. January 2026. That's the month COMEX gets stress tested. Because January is a delivery month. The month when traders can stop playing with paper contracts and demand the actual metal. And with an 82 million ounce inventory and a $25 arbitrage opportunity, the math is about to get very uncomfortable for COMEX. We've established two things. 1. There's a $25 gap between New York and China. Paper says 74. Physical reality says 100. 2. Western vaults have been draining for 5 years. COMEX inventory down 70%. London tight. Shanghai at 10-year lows. Now here's the collision course. If traders realize they can make $25 per ounce just by standing for delivery and shipping to China, how many take that trade? And if too many take it, if delivery notices exceed 82 million ounces, does COMEX have the metal? Let me explain how COMEX delivery works because this is the mechanism that could break. When you buy a COMEX silver futures contract, you're not buying silver. You're buying a contract that gives you the option to take delivery on a specific future date. Most traders never take delivery. They roll forward close for profit or loss, or let it offset their physical position elsewhere. In normal markets, 90 to 95% of contracts are rolled or cash settled. Only 5 to 10% stand for delivery. Why? Because most traders are speculators. They want price movement, not trucking 55-pound bars to storage. Taking delivery is expensive and complicated. But January 2026 is not normal. Here's the math facing every trader right now. Option A, roll forward or cash settle. Take your profit or loss. Done. Option B, stand for delivery at COMEX. Receive physical silver at $74 per ounce. Pay withdrawal and logistics fees about 20 cents. Ship to China 50 cents. Sell to Chinese buyer at 100. Net profit, $25.30 per ounce. On a standard 5,000 ounce contract, that's $126,500 profit in 1 week. On a 10 contract position, that's $1.265 million. Risk level low. This is the definition of risk-free arbitrage. Every rational trader should take option B. Now here's where it gets tight. COMEX has registered inventory. Silver in approved vaults available for immediate delivery. As of 2023, 82 million ounces. Current status as of December 31st, 2025. Needs verification. I'm awaiting the updated CME report. If the drain has continued, this number could be lower. For calculation purposes, assume it's held at 80 million ounces. Each COMEX contract equals 5,000 ounces. 80 million ounces equals 16,000 contracts worth of deliverable silver. Open interest, that's the total number of contracts outstanding, the total amount of bets on the table. Typically ranges from 150,000 to 250,000 contracts. Let's assume 200,000 contracts currently. Normal delivery rate, 5 to 10% stand for delivery. That's 10 to 20,000 contracts, or 50 to 100 million ounces. Already we have a problem. Even normal behavior could exceed 80 million ounces inventory. But with $25 arbitrage incentive, If 20% stand for delivery, that's 40,000 contracts, 200 million ounces requested. Available, 80 million. Shortfall, 120 million ounces. COMEX cannot fulfill. So what happens if delivery requests exceed inventory? COMEX has two options. Neither is good. Option 1. Cash settlement. COMEX declares we cannot deliver the full amount requested. We will settle remaining contracts in cash at current spot price. Traders who wanted metal get dollars instead. Immediate consequences. Paper price loses credibility. If COMEX can't deliver at 74, then 74 isn't the real price. Traders realize the paper market is detached from physical reality. Confidence collapses. For 50 years, the assumption was if I stand for delivery at COMEX, I get the metal. That assumption is dead. Capital flees COMEX futures, moves to physical markets or silver-backed ETFs. Pricing authority shifts. Shanghai physical market becomes the benchmark because that's where actual transactions occur. COMEX paper price would gap up toward 100 within days. Shorts face massive losses. Question spread. If COMEX silver can't deliver, what about COMEX gold? Copper? Can these paper markets be trusted? Volatility explodes. Option 2. Force majeure. CME Group declares force majeure. Unforeseeable circumstance prevents contract fulfillment. Delivery obligations suspended indefinitely. Immediate consequences. Panic. Force majeure in a major commodity exchange signals system failure. Legal chaos. Lawsuits from traders who expected delivery. Regulatory investigations. Media firestorm. Mainstream coverage, not just Bloomberg. Anyone holding COMEX contracts tries to exit simultaneously. Market freezes. Same result as option 1 but worse. Not just COMEX loses credibility, COMEX has failed. Contagion accelerates. Potential government intervention. Criminal investigations into fractional reserve practices. Whether cash settle or force majeure, the result is the same. COMEX loses its 50-year role as global silver price setter. The paper price becomes irrelevant. The physical price, the price in China, the price dealers charge, the price industrial buyers pay becomes the price. Here's what you need to understand, and this is the most important point in this entire video. This isn't about predicting whether silver hits $100. This is about whether the delivery system still functions. For 50 years, the global silver market has operated on a single assumption. COMEX can always deliver if you stand for delivery. That assumption underpins the entire paper market. It's why traders trust COMEX pricing. It's why industrial hedgers use COMEX to manage risk. It's why the world accepts COMEX as the benchmark. If that assumption breaks, if COMEX has to say sorry, we don't have the metal, then the paper market loses its anchor. And when a market loses its anchor, price discovery goes vertical until it finds a new equilibrium. That new equilibrium is probably somewhere close to the physical price in China, because that's where the actual transactions are happening. That's where buyers with inelastic demand are paying whatever it takes. This is the test. Can COMEX still deliver? Or has the 5-year drain pushed inventory below the critical threshold? We find out in 31 hours. Now you might be thinking, surely the bullion banks see this coming. Surely they can do something to prevent this. Can't they just manage it? That's the question. And the answer is, they're trapped. Because the people who are short silver, the ones who sold it at 74 expecting to buy it back cheaper, they're the same people who don't have the physical metal to deliver. They're short paper. But the market is demanding metal. And when you're short a market that's running out of physical supply, you're not in control anymore. The shorts are bleeding. The dealers are scrambling. Let me show you what happens when the trapped players try to get out. So here's the question. Who's on the wrong side of this trade? And the answer is some of the biggest names in finance. The bullion banks, the market makers who are short silver at $74 while the physical market is trading at 100. The dealers, the retail silver shops who've run out of inventory and are calling customers, begging to buy back coins at above spot price. And the system itself, the web of margin, leverage, and counterparty risk that holds this market together. Because when a market this tight faces a delivery squeeze, It doesn't just affect the traders who got the call wrong. Cascades. Let me start with the bullion banks. These are the market makers. They provide liquidity to COMEX by taking the other side of trades. When speculators go long, banks often go short. This is normal. This is how markets function. But right now, the banks are facing a problem. Let me explain mark-to-market in plain English. It's calculating your profit or loss at today's current price, not the price you entered at. If you shorted silver at 74 and the market is now at 100, you're marked at a $26 loss per ounce. Even if you haven't closed the position yet, your broker sees that loss today. Here's hypothetical math to show the mechanism. Imagine a bank is short 10 million ounces. Short entry, 74. Physical market, 100. Mark-to-market loss, 26 per ounce. Total loss on 10 million ounces, $260 million. If they're short 50 million ounces, that's 1.3 billion. This is illustrative. I'm not claiming any specific bank has this exact position. Actual positions are proprietary. The point is showing how losses scale. In a normal market, when you're losing on a short, you cover. You buy back, close the position, stop the bleeding. But they can't cover easily. Many bullion banks operate fractional reserve for physical metals. They borrow silver from vaults, sell it into the market, promise to return it later. But the same bar might be leased multiple times, rehypothecation. One bar backs 3 or 4 paper claims. This works when most traders cash settle and vault inventory is abundant. But now traders are demanding physical and inventory is depleted. When the bank needs to cover their short, they need actual metal. And they discover the silver they thought they could access isn't there. It's been shipped to China. To cover, you must buy silver. But buying pushes the price higher, which increases your loss on the remaining short position. This creates a feedback loop. Price rises, margin call hits, bank must cover some shorts, buying pushes price higher, more margin calls on remaining shorts, forced to cover more, price rises more. This is a death spiral. The bank is trapped. Every action to reduce loss increases the loss. Now the dealers. Normally when you go to JM Bullion or APMEX, they have inventory. But right now, retail premiums for American Silver Eagles are $16 to $21 over spot. Normal premium, 3 to 5. Current, 16 to 21. That's 300 to 400% increase. The real retail price of physical silver in the US isn't 74. It's 90 to 95. Industry reports suggest some dealers are offering to buy back silver from customers at spot plus $2 to $5. Normally dealers buy back at spot minus 1 or 2. They need margin to resell. Paying above spot is desperation. It means dealer is out of inventory, has customers waiting, needs metal now. Some dealers are quoting 4 to 6 week lead times or showing out of stock entirely. When dealers pay above spot to buy back from customers, it tells you one thing. The COMEX spot price is fiction. The real price, where physical actually trades, is 90 to 95 in the US, 100 in China. Here's the mechanism that forces price adjustment. Imagine 2 water tanks connected by a pipe. Tank A at 74 inches, tank B at 100 inches. Water flows from A to B downhill. As water leaves tank A, the level drops. Eventually tank A's level rises to match tank B, or tank A runs dry. There's no third option. Right now the paper market prices silver as if supply is abundant, but metal is fleeing to China. As inventory approaches zero, price must rise to ration remaining supply and close the arbitrage gap. When COMEX equals 100, no more profit in shipping. Economic gravity. Prices must equilibrate across connected markets. And here's where this goes from a problem for silver traders to a problem for the financial system. Bullion banks don't operate in isolation. They have counterparties, other banks who lent them silver, hedge funds who have positions cleared through them, industrial hedgers relying on them for price protection, clearing houses who guarantee trades. If one major bullion bank fails, can't cover shorts, can't meet margin calls, can't deliver silver they promised, what happens to their counterparties? Historical parallel. September 2008, Lehman Brothers collapsed. Lehman had thousands of counterparty relationships. When they failed, Everyone with a contract faced counterparty risk. Will I get paid? Is my hedge valid? The result? Credit freeze. Banks stopped lending to each other. The global financial system seized up. Required government bailouts totaling trillions. If a major bullion bank fails because of silver losses, their counterparties face direct losses. Other banks ask who else is exposed to silver. Credit freeze follows. Questions spread to other commodity markets. If COMEX silver can't deliver, what about gold? Copper? Is this a problem with the entire paper commodity system? Government intervention becomes necessary. Here's the insight. The shorts aren't in control anymore. In a normal market, shorts with deep pockets can wait out the longs, create volatility, defend positions. But not when the market is running out of physical supply. You can short paper all day. You can sell 1 million contracts. But when traders say, I don't want your paper, I want the metal, you have to produce the metal. And if you can't, you lose. You can't short your way out of a physical shortage. That's the fundamental reality the banks are facing. The market doesn't care about balance sheets or risk models. The market cares about atoms, actual bars of silver in vaults. And the vaults are running low. The shorts are bleeding. The dealers are scrambling. The system is being tested. So what happens next? I can't predict the future. No one can. But what I can do is give you a framework. I can map out 3 scenarios based on the mechanisms we've discussed. And I can give you a watch list, 12 specific data points you can track yourself to see which scenario we're heading toward. No speculation. No hype. Just plumbing. Let's map the possibilities. Alright. We've walked through the mechanism. The gap between New York and China, the vault drain over 5 years, the January delivery test, the trapped shorts and stressed dealers. Now, the question everyone wants answered, what happens next? I'm going to give you 3 scenarios and a watch list of 12 data points so you can track this yourself. But first, let me be very clear about what this is and what this isn't. This is not a prediction. I'm not telling you silver is going to hit $100 by February, or that COMEX is definitely going to default, or that a bank is definitely going to fail. What I'm giving you is a conditional framework. If X happens, then Y becomes likely. If Y happens, then Z becomes likely. This is system analysis, mapping the plumbing, showing you the pressure points, giving you the data to track it yourself. Scenario 1. Base case, 60% probability. Tension but no break. Delivery notices come in at 40 to 60 million ounces, below the 80 million threshold. COMEX delivers, but inventory drops to 20 to 40 million ounces, critically low. Price rises gradually over Q1 2026. January, 76 to 80. February, 85 to 90. March, 90 to 95. The gap narrows from $25 to 10 or 15 as New York catches up. No system break. COMEX maintains credibility but weakened. This sets up another test in March or May delivery cycles. The problem isn't solved. It's deferred. Signals you'd see. COMEX inventory declining steadily, 5 to 10 million per week through January. No dealer suspensions, quotes still available, premiums high but stable. Media coverage moderate. Silver rally continues but not crisis headlines. Volatility elevated but not extreme. Daily moves $2 to $4, not 10 plus. CME margins raise 10 to 20%, normal risk management, not panic. Scenario 2. Stress case, 30% probability. Bank panic, price gaps up. Delivery notices hit 80 to 100 million ounces, at or exceeding inventory. COMEX scrambles to source additional metal, negotiate cash settlements, possibly delay some deliveries. One major bank decides to cover all short positions in 2 to 3 trading days rather than manage gradually. Price gaps up $10 to $20 in a single day or overnight session. Close Friday at 76, open Monday at 95. Shanghai premium spikes. China price hits 120 to 140 as West can't supply. Media frenzy. Bloomberg, CNBC headlines. Silver shortage, COMEX under pressure, bank losses mount. Signals you'd see. CME raises margins 50 to 100% suddenly. Sign they're worried about defaults. Open interest drops sharply, 10 to 20% in 1 week, massive covering. Multiple daily articles, silver crisis, delivery concerns, bank losses. At least one major dealer shows out of stock on key products. Options activity explodes. Call options at 80, 85, 100 strikes see 200% plus volume increase. Price gaps overnight. Scenario 3, break case, 10% probability. System failure, pricing authority lost. Delivery notices over 100 million ounces, well beyond available inventory. COMEX declares force majeure, cannot fulfill deliveries, suspends physical settlement temporarily or indefinitely. Price chaos. Physical silver trades at 150 to 200 per ounce in private bilateral deals. COMEX paper price becomes irrelevant. Government intervention. CFTC, Fed, Treasury hold emergency meetings. Possible bailout of bullion banks, trading halts. Contagion. Questions spread to other COMEX metals. Can they deliver gold? Copper? Platinum? Permanent decoupling. Shanghai Gold Exchange becomes primary price setter for physical markets globally. Signals you'd see. COMEX announces delivery suspension or cash settlement only for silver contracts. Unprecedented. Multiple dealers globally suspend quotes, not taking orders at any price. Emergency Fed, Treasury, CFTC statements, possibly trading halts. Mainstream media coverage, CNN, BBC, not just Bloomberg. Other commodity prices spike in sympathy as markets question entire delivery system. Government intervention announced, bailout, guarantee program, regulatory investigation. Now a quick note on those probabilities, 60%, 30%, 10%. These are my analytical judgment based on the evidence I've presented. Inventory levels, the deficit, the arbitrage incentive, historical COMEX delivery behavior. They are not based on a statistical model. They're not a guarantee. They're my assessment of likelihood given the mechanisms we've discussed. Your assessment may differ. You might look at the same evidence and conclude the stress case is more likely, or the base case is less likely. That's fine. The point of giving you the scenarios is so you can map the possibilities, so you understand the range of outcomes and can recognize which one is unfolding as the data comes in. You're not supposed to accept my probabilities as gospel. You're supposed to use the watch list to track the signals yourself. Here's the 12-point watch list. COMEX registered inventory. Check CME Group website daily. Warning level below 70 million. Danger below 50 million. U.S. dealer premiums. Check JM Bullion, APMEX, SD Bullion for Silver Eagle prices. Warning over $15 above spot. Danger over 25. Shanghai Premium. Check Shanghai Gold Exchange via Reuters or Kitco. Warning 85 to 95. Danger over 110. Lead times. Dealer websites estimated shipping. Warning over 6 weeks. Danger over 10 weeks or out of stock. COMEX open interest. CME Silver Futures Weekly Report. Warning if drops 10 to 15% while price rises. Danger if drops over 20% in 1 week. Delivery notices for January 2026. CME publishes end December or early January. Warning over 40 million. Danger over 70 million. Margin requirements. CME Silver Futures Performance Bonds. Warning increase 20 to 30%. Danger increase over 50% suddenly. Dealer quote availability. Check 3 to 5 major dealers daily. Warning 1 dealer limited stock. Danger 2+ suspend quotes. Options volume for calls. COMEX options data at 80, 85, 100 strikes. Warning volume 50% above average. Danger volume 200% plus above average. ETF flows. iShares Silver Trust Holdings publish daily. Warning inflows over 5 million per week. Danger inflows over 20 million per week. Media coverage intensity. Count Bloomberg, CNBC, Reuters headlines per day. Warning 1 to 2 silver articles daily. Danger daily front page crisis coverage. Interpretation. If 3 or more indicators hit warning level, market is tight, watch closely, base case playing out. If 2 or more indicators hit danger level, market stress is high, stress case becomes more likely. If 4 or more indicators hit danger level, system at breaking point, break case possible. This isn't speculation. This is reading the gauges. Every indicator on this list is publicly available data. You can check these yourself right now and see where we stand. Here's what happens next on this channel. I will be tracking these 12 indicators every week through January and February 2026. I'll publish updates here. Here's what inventory did this week. Here's what delivery notices look like. Here's which scenario we're trending toward. No hype, no predictions, just data. If you want to follow this story, subscribe to this channel and turn on notifications. I'll have the first update on January 7th, 2026. After the first week of January delivery notices are published. Final disclaimer. This is not financial advice. I'm not telling you to buy silver, sell silver, trade silver, or do anything with silver. This is system analysis, a deep dive into how a commodity market under structural stress behaves. If you make financial decisions based on this information, you do so at your own risk, based on your own research and circumstances. We've covered the gap, the drain, the delivery test, the trapped players, and the 3 scenarios. Now we watch the data. I'll see you on January 7th with the first update. Until then, track the signals. December 2025 isn't just about silver going up. It's about a 50-year-old global pricing system facing a fundamental question. Can it still deliver? When paper says 74 but physical trades at 100, when inventories have dropped 70% in 5 years, when China locks down exports and traders start demanding metal instead of contracts. Those are the signs of a system stressed to its breaking point. Here's the takeaway. Don't just watch the price on your phone. Track those 12 system signals we walked through and always ask yourself, is this confirmed? Or is this just an early sign that needs verification? Because in a market under stress, the difference between confirmed data and circulating rumor determines whether you understand what's actually happening or you're just caught in the noise. When a system gets pushed to a choke point, price is just what you see on the surface. The real danger is that trust in the underlying mechanics is starting to crack.